All right, Matthew. Thank you so much for joining me for this class, Your Ultimate Guide to Buying a Home in 2024. I'm so excited to hear what you say about what's going to happen with the market this year.
No, I appreciate you having me. It's a great opportunity to join you, be able to educate our buyers, not just for what's coming to 2024, but in the future, and
Exactly.
make sure we get them into the house of their dreams, whether it's their starter home, their forever home, in the easiest and simplest way possible.
Fabulous. For those of you that don't know me, I'm Liberty Walker. I'm a realtor and I'm helping people in the Austin area. And, anywhere in Texas, if you need to find a home, I'm the gal to help you do it. And then Matthew, tell us a little bit about yourself. You're a mortgage broker with One Real Mortgage.
Yep, I started in the industry back in 2009, so right around 15 years of experience. At the end of the day, I love helping people get into their new home. There's a real sense of satisfaction. I know I'm able to walk away with it at the end of the day. I know you are as well. And a lot of times, especially for our new buyers, I know the questions that they're going to ask before they even have them. And for me, it's all about simplifying the process for them and letting them know when they attend things like this, there's no bad questions. We want them to walk away, knowing that their questions are answered, because the worst thing is walk away wondering and assuming the answer to a question, not knowing what it's going to be and causing yourself more anxiety.
Exactly. I feel like that's the main reason why that's where they get held up on. It's like, I'm scared. I don't make enough money. I don't have enough. How am I even going to start this process? So we are here to go through the steps to purchasing a home. What do you need to do, and how you can do it exact this year or beyond. And
Oh, absolutely.
you're a mortgage broker. Can you explain to us what is a mortgage broker versus a lender, or maybe someone going to Wells Fargo where they might have a savings account and saying, "Hey, I want to buy a home." Can you kind of tell us the differences between the three?
Absolutely. So, being a mortgage broker, we actually work directly with lenders. So it gives us a real opportunity to find our buyer the best loan type for their situation. So there's 13 lenders that we work with across the country. So we have endless opportunities to make sure we can help the client every single time. A direct lender is going to be your Wells Fargo, your UWM, Loan Depot, Better.com, Guaranteed Rate. Those types of lenders, they are very what we call in the box lenders. So they're going to stick strictly to FHA, VA, conventional USDA loans. If you don't fit in the box, they're unfortunately going to brush you off, say, we can't help you. We don't want to have that. We want to be able to avoid that opportunity and make sure we're doing everything we can to help our buyers. When we talk about some place like a Wells Fargo, nothing against the big banks. They're great. They're great for accounts. They're more worried about their checking accounts, their savings accounts, their CDs, their car loans, their credit cards. That's how they make their money. They stepped away from the mortgage industry a long time ago because they know the amount of work it goes into it. It's not financially worth it for them when they can divert those funds and those workers and that all of that investment into a simpler form of profit for them.
So what I'm hearing is that a broker can look through multiple different lenders. So instead of the buyer having to see what deal they're going to get at Rocket Mortgage or see what deal they can get at better.com, you're able to look over that wide range of options and pick the best one for them.
Exactly. I mean, and for most buyers, they're going to be looking anywhere from 3 to 10 properties. Going to look at a property, it's not a quick 15-minute process. There's time involved driving over there. I know an agent like you, you're going to show them every single nook and cranny of the house, making sure that they really know what they're getting out of that specific house, the
Mhm.
community, their surrounding areas. Then they have a drive back. You're probably looking, an hour or so for every single house that you look at. If a buyer goes and looks at 10 houses, that's already 10 hours of time they've invested. They're not going to want to go out and, talk to two, three, four, five different lenders and invest another 5, 10 hours of time.
It's a
And
lot.
Yeah, and that's one of the really nice things about working with a broker. We get to alleviate all of that stress for them, save them all of that time because people, we're busy. We know it. I get it. We have families, we have work, we have things outside that we like to do. And by even being able to freeing up that little bit of time for them, it gives them more time to actually focus on their life.
And I will interject a personal story. When I first purchased my house that I live in now, I used Rocket Mortgage. It was before I was a realtor. Don't take me to jail for using them. But just working with them directly was not a great experience for me. Every time I called, it was a different person I had to talk to. I had to explain what I needed about 5 different times, and it was really frustrating. So I can see if you were the main point of contact, I could get the deal, but that I could still have that comfort of being able to talk to somebody that's an actual person who knows me. So, well, that
Exactly. And like you say, it's all about comfort. Me personally, I tell everybody, every agent I work with, every buyer I work with, I work remotely, I work from home. I am available 7 days a week for the buyers, for the agents as well. There's no worse feeling than having a question on a Friday afternoon, knowing you're realistically from most other
yeah,
places, you're not going to hear back until Wednesday morning, Wednesday afternoon if you're
exactly.
lucky.
And for someone like me, the realtor who needs that pre-approval letter, which we'll get into a little bit later, why we need those things so quickly for to make an offer. But if I need to reach you at Sunday so that you can bump up our approval letter or see how far we can go, I need to talk to a lender.
Yeah, or
So
even drop that pre-approval down so we're not showing the buyers full hand when they make that initial offer.
that's great. Well, we have a few people that have joined the class. So I want, this is a very conversational class. If you guys have questions, you can drop them in the chat. We'll try to get to them as we go along. We'll have some time at the end to answer any questions that you might specifically have. But right now we're talking about what just the differences, how to choose your lender. And then once you get through that point, Matthew, let's say I'm a home buyer and I want to start my home search. And the first thing that I tell people to do is to get pre-approved. And when I tell them to do that, they get a little freaked out because word on the street is when you have that, when you get that hard credit pull, when you go to a lender and get approved, that's going to negatively affect a credit score. Can you tell me what does that really do? Does that
Yeah,
really hurt me?
absolutely. So the one nice thing about us is every buyer that we work with, we start the process with what's called a soft credit pull. And we do it for quite a few different reasons. One, it still gives us all the information that we need to see. Credit scores, any open accounts, anything negative that may be showing. It still gives us all the information we need to be able to provide the pre-approval. The other reason we don't do the hard pull to start is it may take that specific buyer 2, 3, 4, 5, 6 months to find the home that they actually want to make the offer on. Your standard credit pull is only good for 90 days. We don't want to have to do that hard pull in the beginning. It takes 3 months to find a home. Their credit report expire, have to do another hard pull, and now we're looking at two hard hits on the credit report. We do that hard pull once you are under contract. And it just makes for a better overall experience for the buyer because the hard pull, it is going to have a little bit of an impact. If you have good credit, it's usually very, very minimal. It's usually a very, very short period of time that you actually see the impact of their credit scores. And the nice thing is, as long as you're 720 or above when you're applying for the mortgage, you're still going to be in that best pricing tier for interest rates. So if you start with a 804 and you go down to a 780 after the hard pull, you're still in the best tier that you can be in.
Oh, wow. So it might be like, because I mean, we all know like good credit, bad credit scores. I could say that maybe like anything. What do you recommend if I went to read my FICO score at Wells Fargo and it says I have a 580? What are you going to tell me when I come to you?
So that's the nice thing. We have an actual in-house credit repair team. So even if we can't help you at that point in time, it doesn't mean we're going to be like everybody else and say, "Hey, Liberty, sorry, you don't qualify. Move on to the next person." What we're going to do at that point is actually dive into your credit report. Like I said, I've been doing this for 15 years. I have a lot of knowledge. be able to give guidance on what that specific borrower needs to do to get their credit scores to the 620 minimum. Also, with the credit repair team, they actually have a proprietary algorithm that actually links into the credit bureaus. So they can go through the credit report, see what would happen if we pay off this $250 collection, pay down this credit card from $1,000 to $750. Do anything we can to get them to where we need the minimum credit score to be to get them in a position to buy the new home.
That is so great because when I look at my own personal situation and I might have some student loan debt, I have a brand new car sitting in the driveway. I have these different things. And then I'm like, well, what should I do so that I can improve and get qualified for that loan? But if you're on your own, you may be putting your efforts and your money towards something that might not help you get approved. I was
Correct.
hearing the other day that when you have your credit card, you may have like a $20,000 credit card. When you do your calculations for debt to income, they're not looking at the full amount of that credit card that you owe. They're looking at the minimum monthly payments. And that blew my
Absolutely.
mind. I
Yep.
was like, oh my God, maybe I shouldn't put that whole commission check on my credit card and pay it off because it's just the minimum monthly payment. So can you talk about debt to income? What is debt to income? What do buyers need to know about that so that they can better prepare to purchase a home this year?
Of course. So I always had to keep things simple. We call it KISS, keep it simple, stupid. So always wanting to keep everything as basic as possible for people because I never like anybody to be confused or walk away like, oh my God, what did he just talk about? So the simplest explanation for a debt to income ratio is your gross monthly payment divided by any debts on your credit report plus the anticipated monthly mortgage payment.
Okay,
Again,
that's a
I'm a
lot, Matthew. My eyes are already going cross-eyed. That wasn't KISS.
Ex
That was not.
exactly. So I'm gonna actually simplify it.
Okay.
So say somebody makes $10,000 a month in income. You have $2,000 a month in credit cards, student loans, car payments. And let's say you want to have a $2,500 a month car pay or mortgage payment. When you add up all of your debts, it comes up to $4,500. When you divide that into your $10,000 a month gross monthly income, your debt ratio comes out to 45%. So you always want to keep your debt to income ratio at or below 50% of your gross monthly income.
Okay, that seems simple enough. What
Yeah.
about people that don't have regular income, Matthew? What about someone that's might be a realtor, have
So, yep.
irregular income, big lump sums throughout the year? What are you going to do for those people?
So those are the people that, again, the direct lenders, your UWMs, your better.coms, your guarantee rate, they're typically going to turn their nose at because it's a little bit of a more difficult income to qualify off of. With us, again, being a broker, having 13 lenders that we work with, there's a lot of different programs that we have access to. We have something called a 1099 loan. The way it works is, let's say you brought in $150,000 showing on your 1099 for 2023. What we do is we actually take that actual lump sum that you made, we spread it out and divide it over a 12-month average, which would be $12,500 a month. And then because you are considered self-employed, there's what is called a 50% overhead. So assuming about half of your income goes to actually operating your business, meaning for somebody like yourself, your actual qualifiable income would be $6,250 a month. Really, really simple, nice way to still be able to help our 1099 workers, our gig workers, still give them that path to home ownership.
That's amazing because we need homes too, Matthew.
Yep.
We do too. Well, now that we've covered your debt to income, we know what our monthly payments might be, how we can meet with you, talk about our credit score, improve that to get going to purchase a home. What about our down payment amounts? It's there's some there are still people out there that think that you have to have 20% of the purchase price to own a home.
Correct. It's probably one of the biggest, worst myths about buying a home. Everybody always says 20%, 20%, 20%. So can you do 20%? Sure. Are there
You have
opportunities
20%.
for people to do no down payment? There are.
What are those?
So and those are what's called a VA loan, specifically designed for our veterans and their surviving spouses. So you do have to be, at some point enlisted in the military to be eligible for a VA loan. So that is, unfortunately not the largest select, group of people throughout the country, but the veterans, they put their lives on our line for us. They deserve something special dedicated just for that.
Of course. Thank you for your service.
There's another loan program called a USDA loan. This one is a little bit more restrictive. And the only reason I say use the word restrictive is because it's based on location. So the USDA, the US Department of Agriculture, actually has a specific loan program designed for rural areas. And it does allow for a no down payment option. You can actually finance part of the cost into the loan. There's opportunities and instances where I've actually had the buyer walk away at the closing table getting a check. Yes,
Yes, yes. And I've experienced that too, believe it or not. They redraw whenever they're talking about USDA qualifying properties. It's usually a property that may be on the outskirt of the city. It's in a more rural area. And the reason why they're in that USDA zone is so that we're encouraging people to move there and
correct.
build homes there and
Yep.
live there. And believe it or not, there are USDA homes around the Austin area. And each year it keeps getting a little further out, but we worked with a buyer in 2020 that was in Liberty Hill, which is a very thriving community. And I am going to go ahead and share my screen. Marisha, I see your beautiful picture there. And I can hear
And
you.
the nice
I
thing
hear
about
you a
the
little bit.
USDA loan, Liberty, is, and I can even, share this with you. If there's ever a property somebody's looking at, they're not 100% sure if it's USDA eligible. Because you know how it is when somebody puts something online or puts something in the MLS database to actually show a new listing, they typically show what the acceptable financing types are. Not all agents will list a USDA loan. So all they have to do is, get a specific address over to you. You can share with me. They can let me know directly, and I can actually look up that specific property within the USDA's tool.
That is amazing. And I have a feature in my MLS that helps me find USDA properties specifically. There's not a lot of them out there, but if you're wanting to explore that and find those, there's a way. So let's say that we can't find, we did not serve our country and we did not find a USDA loan that's acceptable. What then is the most down payment that I'm going to need for the
The,
next year?
the standard typical down payment at that point is anywhere from 3.5 to 5%. There are instances where we can do a 3% down payment on a conventional loan. But again, for simplicity, I always like to keep it basic. Most of the time, expect anywhere from a 3.5 to 5% down payment.
3.5 to 5%.
Correct.
And then that's just depending on your own specific qualifications.
Correct.
And then some things that we really don't think about, closing costs, Matthew. How much should we save for those?
So closing costs is a very, very broad word that people are typically thrown off about. I kind of incorporate and encompass everything that you're bringing to closing outside of your down payments or closing cost. And what those typically entail is the appraisal. The house is going to have to be appraised, make sure what the buyer is paying for it is actually in line with the actual current market value. There's other things that are called third party fees or your title fees. So a title company that's assigned, typically picked by the buyer, or sorry, by the seller, is actually going to do what's called a title search. They're going to go back into the history of the home, the history of the title, make sure there's no unexpected unknown liens that may pop up in the future, make sure the title is clear, and then they actually do what is called title insurance. So they're actually going to ensure that the title is cleaned. And if anything ever happens in the future, they will actually help to cover the cost of rectifying that and making sure the title is clean going forward.
So you definitely
So
want that.
absolutely. I mean, nobody likes anything unexpected happening, especially after you buy the new home.
And the one example that we always use in real estate school, it's like that distant cousin Fanny that pops in like 5 years later is trying to claim that home was supposed to be left to her. And so that's why we have this title insurance, so that things like that, anybody who comes and is trying to claim that they own that property, there's insurance to cover that. And it also covers
Correct.
other things like if your home is built on a utility easement. I mean, everything's considered. So it's really good to have. And I mean, those vary and it's usually based on the price of the home too. So the more expensive the home, the more expensive the title policy is going to cost.
Correct. Yep. And then you have your what's called your per diem interest, and what that is it actually all mortgage payments are paid and covered in arrears. So if I'm going to make my February mortgage payment, it's actually going to cover the interest for January. Very weird thing about mortgages, but it is the way it's set up.
That is.
So
Why do they have it's like at every turn they try to make it more and more complicated.
correct. And that's just been the industry standard since before I started. But it's always just to make sure that the time between closing and the end of the month, the interest is paid for it. So that's another what's considered a closing cost. And then the final part is going to be your taxes and insurance or your escrow account setup. One thing I always let buyers know is your first year of insurance is always prepaid. So it's a little bit different than your car insurance where you can pay a month to month, you can pay it quarterly, semi-annually, or annually. Your first year of homeowners insurance is always prepaid. And then you typically sub the escrow account where your tax and insurance go as part of your monthly payment. With depending on the time of year, I always air about 4 months of taxes and 4 months of insurance. That way, as they're making their payments every month, a portion of their monthly payment will go into the escrow account. When their taxes come due, the funds are readily available to pay the taxes on the owner's behalf. And then same thing with the insurance. When the insurance comes due, the funds are going to be available to renew the policy, go ahead and pay for it for the next 12 months. So that way, next time it comes due, the funds are readily available.
Beautiful, beautiful. And that brings me to my next slide here, which are seller concessions. So right now, which is more unique that we've seen this year than other years, is that sellers are actually to sell their house to give some incentives. They're willing to cover some of the buyer's closing costs. We've also been able to negotiate title and who pays for that. So that's a huge savings that you might not be able to count on. Like I wouldn't think that, oh, let's start my home search. I'm going to count on the seller covering these costs. But if you save 6% or 6.5%, there's a chance that you will be able to get some of that covered. And let me see, there we go. So that's exciting.
Yeah, seller concessions are huge. I would say about 90% of the purchase agreements or contracts that I see actually have the seller contributing something to helping the buyer pay those closing costs. And another thing that buyers always ask me, and I'm sure they'll, ask you the same thing, is it better to offer full asking price or ask for seller concessions or, what's the best approach?
Right. Yeah. What do
You
you
know,
say?
and I always explain to buyers, it's all about simplicity. If a seller is offering or selling a house for $380,000 and you want seller concessions, let's say $10,000. If you offer the full asking price of 380 and get the $10,000 in seller concessions, it's always better to have that extra $10,000 in your bank than going in at a $370,000 asking price. And again, breaking it down to simplicity, if you take $10,000 divided by 360 months, that's how many months there are in a 30-year mortgage. It comes out to about $28 a month. Let's say 50 bucks a month once we added interest and everything. And I always ask buyers this, I'm like, what's going to be more beneficial for you?
Right.
Having 10 grand in the bank or a $50 a month lower payment? They're going to laugh. They do laugh at me every single time I say, Matt, well, what do you think? I know you'd rather have 10,000 extra dollars in the bank.
Exactly. Exactly. Especially since you never know how long you're going to be staying in that home. So you want to have the most control.
Exactly. It's life. Unexpected things happen. It's always nice to have a little bit of extra money in the rainy day fund.
And so there's a maximum amount of seller concessions that can be contributed. And those are
Correct.
guidelines that the lenders have, right? Or the Fannie Mae and Freddie Mac put in place.
Yeah,
So
and it's really, really easy. 6%, no matter the down payment on an FHA loan. On a conventional loan, if the down payment is less than 10%, they can request up to 3% of the purchase price of the home in concessions. If the down payment is over 10%, they can request up to 6% of the purchase price in seller concessions.
that's amazing. That's a lot of
Yeah.
savings.
Yep.
And, these days we try to ask for it all, a little bit off the sales price and a little bit towards closing, whatever we can do to make that buyer happy and to choose that home. Home inspections. So, another fee, another piece of money that you're going to have to pay when you're getting ready to purchase a home are going to be inspections. They're not required, but I always recommend getting a home inspection. It's a snapshot of the current state of the home, and it's a wonderful thing to get during your option period once you go under contract. Home inspections are based on the square footage of the home, and home inspectors, like anybody, they have different prices that they charge people, but for the most part, you could budget around 300 to $500 depending on, so it's not like a huge amount of money, but it's definitely worthwhile so that you can get a home inspector into that home. They're not going to look like inside the walls and they're not foundation experts or roofing experts, but a lot of them have so much knowledge that they can shine on if you might need to consult further trades to get quotes on what it's going to be. And this is typically when you buy a resale home, but when you also build a home from the ground up with a new construction home, you're also going to want to get inspections at different phases of the build to get an idea of how that home is coming together.
Yeah, I agree 100%. I think the inspection is so important and it protects the buyer even more so. Because like you said, like the inspector has so much broad knowledge that they can look at your HVAC system, they can look at your hot water heater, they can look at some of the electrical panels, and at least be able to do a quick snapshot of seeing if there's anything significant that's standing out. An HVAC system getting replaced can be $10,000.
Exactly. These big ticket items that, are that's the very last thing that you want to do is to move into your home. And then a week later, your AC goes out in the middle of the summertime and
Yep.
you're sweating it. You're
Yeah,
sweating.
and that's why that inspection is so important because if the inspector does find potential issues, it gives the buyer, especially during the option period, the opportunity to negotiate to have some of those repairs fixed. And you can always start at the bigger things and then work your way down to negotiating, if there's some peeling paint, if there's a, accidental cracked window or something. It's all about making sure that we're putting our buyer in the best position possible with that new home.
Because we're talking about repairs, I have a question for you, Matthew. How do you, as the broker and lender, view repairs?
That's a great question. So I always like to ask the agent, what is the condition of the home? I have a little checklist that I always go through, ask if there's broken windows, peeling paint, missing handrails going upstairs. Because some of those things can be flagged on FHA and VA loans because they are a little bit more strict. It's not like they make anybody bend over backwards or anything crazy like that, but they want to make sure that they're putting their buyer in the best position possible and making sure the home is safe to actually live into and occupy immediately. Conventional loans are a little bit more relaxed actually. So they'll let you have cracked windows, not broken because again, safety issue. You don't have to have guardrails or handrails on all the stairs. You can have a hole in the wall on a conventional loan. So a lot of it comes down to, what the appraiser actually sees during the walkthrough of the home. And there's two different types of appraisals at the end in regards to repairs. One is called as is. And what that means is there are some things that the appraiser found, but the as is condition of the home is acceptable based off of that specific loan type guidelines. Meaning Nothing has to be done. We're going to continue forward getting the loan to closing. There's another one called condition two. And what that means is there are specific repairs that the appraiser is requesting to be done in order to condition and sign off on the final appraisal.
All right. That's interesting. Haven't dealt with what a condition loan
Yeah.
before.
And they're not bad. I mean, typically that's why I always like to ask up front. The agent's going to know exactly what to look for 99% of the time. I know you do. And
Mhm.
if we do our little bit of extra 5 minutes of due diligence asking those questions, it's going to keep the buyer in the best position possible.
It's wonderful. Because at the end of the day, Matthew, that's our goal is to just help these buyers and to be their best advocate in these situations. Because nobody wants
Exactly.
to enter into, I mean, unless you're a home flipper, but that's a different class.
Yeah, that is so true.
Well, now that we're talking about appraisals, this has been a huge topic over the past 2 years. And the tone has been that that people have been offering over list price. They've been offering more than what sellers have been asking for. So there might potentially be a gap between what the home appraises for and what the contract price is. And in those situations, Matthew, what did you see in these past 2 years?
So typically prior to, I would say 2023, the buyer ate it. They would bring the difference. If they were already paying over asking price, already over fair market value, it didn't have any impact on them because they were already overpaying for the house.
So
So
they
they
would
was
have to bring additional cash.
correct. Yep.
So
You
now
know,
that the market has shifted a little bit, in 2023, the average sold price was 91% of the contract price. So a little bit less. As of the Austin Board of Realtors just came out with their stats in January. And in January, sellers are getting 93% of what they're asking for. So if they, you know, sell their house for $100,000, it's averaging out to a $93,000 sale. So not too far off. That was
correct.
surprising to me because the tone is like the market's crashing, but really it's actually performing better than last year. So what happens, Matthew, if an appraisal comes back and it comes back over the asking price?
If it comes back over, the buyer is walking into the home with instant equity, literally instant equity. And it's the greatest feeling to be able to call up a buyer and say, the appraisal back, it's as is, it appraised at $430,000. You're buying it for $400,000. You have an instant $30,000 in equity.
That's
And what
amazing.
that does is it's one of the biggest leaders to generational wealth is homeownership.
That's right.
And if somebody knows that they're already walking into $30,000 in equity in the home values are only continuing to go up. And having that opportunity to have that instant equity, it's the best feeling to be able to give that call to a buyer.
Exactly. Was reading a stat from the Austin Board of Realtors that said that 59% of Americans that own a home, they have equity in their home and they're able to use that opposed to having stocks, savings accounts, CDs and things like that, other ways that people invest. The majority of Americans are using home ownership to build wealth and have that asset. And later on, when there is equity, hopefully right up front when you're purchasing the home, but over time, I mean, on average, it's about 5%. Historically, we can see 5% of growth in what your home is worth.
Yeah.
But how do you tap into that? How do you get that money out?
So there's different ways they can do something what's called a home equity line of credit. So essentially what it is, it's a credit card
A
against the value
HELOC,
of your home.
a
A
HELOC, right?
HELOC. Yep.
Yes. Okay.
And the way it works is there's typically what is set up is called a draw period. So say Liberty, you want to do, you were going to redo your kitchen. Let's say it was going to cost $40,000. Let's say your home is worth 400,000 and you owe 200,000. That means you have $200,000 in available equity. So you can actually take a line against that $200,000 in equity that you have to actually finance the cost of your new kitchen. And we all know, we all love cooking in a new kitchen. And it just is a very, very easy and simple way for people to tap into that equity, whether it's for home improvements, home upgrades, debt consolidation. Debt is crazy right now as a country. We just passed $1.2 trillion in credit card debt. So there's a lot of there. I know. I
Yeah.
read it. My jaw hit the floor. I'm like $1.2 trillion dollars. Like I couldn't imagine seeing that kind of money. But knowing that the debt is there, like the equity that people build up, it gives them an opportunity to get that debt paid off and to kind of have a fresh start with just the mortgage payment.
I love that. I love that. It's like a forced savings.
Yep.
And and then later on you could do a cash out refinance, which right now I wouldn't maybe recommend that unless you actually needed the cash desperately, but
Yeah, but even with the cash out refinance, after that, they can refinance again what's called a rate and term and still get a much better interest rate. So everybody's situation is a little bit different.
right.
It's all about finding, what's best for them.
And speaking of what's best for them, the other day we were talking and you said that there were things out there that were down payment assistance programs. And I was surprised to hear that maybe that might not be in the best interest of home buyers. Could you just elaborate on that and let us know why exactly? Should people be using those or should they just really try to buckle down and save for that down payment and avoid using a down payment assistance program?
So a lot of it comes down to the type of down payment assistance program. So Texas has a specific one. I'm not going to mention a name. I don't ever like to throw anything under the bus. But this specific program, it'll actually help buyers cover the entire down payment. I have a love-hate relationship with it, just like I have with technology sometimes. And the reason I have a love-hate relationship with it, I love anything that can help a buyer get into their new home. It's great. It's all about promoting home ownership across the country. What I don't like about this specific program is it actually has what's called a restriction period, meaning the buyer typically cannot refinance, they cannot sell, they cannot do anything to change the term of that original loan for a 3 or 4 year period. And with where rates are right now, there's a 90, 95% realistic reality that we're going to see rates drop not only further into this year, but into next year. And with that program, it comes with higher interest rates than where the market is. So, yes, if we help somebody get into a new home, that's phenomenal. But if we handcuff them and they cannot refinance and take advantage of a lower rate and a lower payment in the future for the next 3 or 4 years, it's all about setting them up for success. Doing something
Exactly.
like that, we're not setting up for the success that they're going to want or need to be able to take advantage of when the opportunity to save money comes.
I can't yes, that would be I mean, everyone's just thinking into the future, when are rates gonna come down? And to just if you were I mean, could you sell the home to get out of it?
So that's the thing. Even if you sell the home within the first 3 to 4 years, you have to repay that entire down payment assistance.
Oh my god.
Yep.
Yeah.
Yes. So the nice thing is with us is some of the lenders we work with, they do offer grants. And the nice thing with the lenders we work with, the grants that they provide, both opportunities that we have, the ones that I work with the most, that I love the most, both grants are immediately forgiven at closing. And what that
Oh,
means,
wow.
yep. And what it means is there is nothing touching title. There is no expectation of repayment for that buyer at any point in time, whether they refinance or sell the home in 6 months, in 2 years, in 20 years. Once they close on the loan, that grant is immediately forgiven. It's gone, and they're walking away with even more money in their pocket because they don't have to worry about that potential down payment. Now, I never tell buyers, don't bank on it, don't anticipate it. It's an option for certain buyers in certain situations, in certain areas. If you're buying $1 million home, you're not going to get down payment assistance. Don't think the opportunity is going to be there. It is designed specifically for lower middle class income families to help them get into that first home.
That is so cool. And so if somebody comes to you with all of these questions, Matthew, you'll be able to go through their specific situation and really get a good idea of what you can offer them.
Yeah, we actually designed a tool that actually tells us exactly based off of where their current location is, where they're looking to live, what their income is, what their credit is. We actually have a tool that will tell us exactly what different programs that specific buyer is going to be available for in regards to different down payment or closing cost assistance programs.
That's so awesome. So I mean, it sounds like whether your credit's not great, whether you have a down payment or you don't, you can meet with them and guide them through to figure out what they can actually do.
Correct. For some people, the dream's not immediate. I'm very, very honest about it. But it's about getting them that pathway to get to the new home. Because if you don't talk to somebody, you don't at least find out where to get the ball rolling from. A lot of people just tend to keep spinning their tires, unfortunately.
And we don't want that. We don't want that.
Exactly.
We want them to get over to you and get approved. And that way, I have a great idea of what they are able to spend on a home. And that might not be what they want to spend on a home. Because when I meet with them and have a buyer consultation, we're not looking at like a house poor number where
No.
every single last penny is going towards your mortgage payment, your taxes, your insurance, your HOA. We're looking for a number where they can still continue the lifestyle that they love, going out to restaurants, budgeting for vacations, buying clothes and toys and all of those things, school and dance lessons and swim lessons and all of those things that might not be part of your debt to income, but it's definitely going to be a part of your budget to live the happiest life that you can. So once we have that house number in mind, maybe not the maxed out number, but the happy living number, then that's when we dive into a home search. And here in the Austin area, right now, the medium home price is $430,000. I will say that in Austin proper, when you're looking at the MLS and at those home prices, if you look below maybe say 350, those homes are not looking so great, right, Matt? We went through some of those ones the other day. We're like, where's the house? It looks
Yeah, unfortunately not. Austin is an ever-growing market. The whole San Antonio, Austin area in general, because they're only about an hour or so away with good traffic. I'm going to throw that caveat out there. As long as the traffic's not horrible, about an hour or so away. But specifically Austin, it's such a growing market. I actually believe it's top 10 in the market or in the country right now in regards to actually expanding markets. And that's the other thing that we were touching on earlier about property values.
yes,
This is the time to buy. If we're
definitely.
looking at a 5% increase year over year, every year that you wait on a $400,000 house, you're missing out on $20,000 in equity. And
I'm
perfect example. On a $400,000 purchase right now, your standard 5% down payment is about $2,000. Your payment is going to be about a little over $2,500 a month. Even waiting 1 year at a 7% increase in property values, which actually isn't unheard of over the past 3 or 4 years, you're gonna
no,
now.
Matthew. Far from, I mean, I have seen like some parts, not every part of Austin, but some areas in Cedar Park and Liberty Hill. I literally have seen 50% home appreciation in value in 1 year.
Yeah, and that's so much missed opportunity for potential buyers because they're now looking at a higher purchase price, a higher down payment, and the craziest part that most people never think of, even with the lower interest rate, the payment's still going to be higher.
I've
So
seen
you're
that.
missing out on a lot of things from a lot of different angles. And again, for me, the most important thing for people is the opportunity for the future with the missed equity.
Exactly. And also, just to throw it out there, if you're renting, the average rental price for a 3 bedroom, 2 bath home is $2,500 right now in the Austin area. If you're renting for a full year at that amount, just imagine all that money that could be going towards growing your asset, growing equity, putting it down and onto a down payment. Instead of that, it's just going out to the landlord's mortgage.
Yep, you're literally paying somebody else's house off for them.
All right, Matthew. This is a wonderful thing because 7% growth, that is, I mean, that's a pretty, I think it was like 11% average of growth in the Austin area. So this is a modest.
Yeah. I mean, even over the last 51 years, I know it's looking back a long time. I'm going to be 40, so this started before I was even
Oh,
born.
happy birthday. Isn't your birthday on Monday?
A week from Saturday
A week from
will
Saturday.
will be the official 40. But in the last 51 years, we've had 6 years of decreases in property values, 9 years of no increase in property values, 35 years. 35 years of an increase in property value of at least 4%.
And people are, I mean, purchasing homes.
Yeah.
According to the Austin Board of Realtors, which is my favorite place to quote from, mortgage applications were up 3.8% in the month of January.
Yep.
So people are doing that. People are trying to get out there and get these homes when the rates are still down. There's still some wiggle room for negotiations, and inventory is going to be more and more as we go into the spring. So you'll have more homes to choose from. Right now, I have, can you see my screen right now? This is the mortgage roadmap.
Sure can.
Beautiful. I just want to go through this in our last 10 minutes here and just look over these document checklists that you're going to need to gather so that you can meet with Matthew and move forward with your application. Driver's license, got that. Purchase contract. Is this for once you, oh, this is once you have the home.
Correct. Yep. So this will be so the three that I always focus on for people for pre-approval, we call it the 222s. Two most recent pay stubs, two most recent months of bank statements, last 2 years of W-2s, or tax returns if you're self-employed. If you're self-employed, it's super important to get your tax returns over up front because there are certain expenses that self-employed business owners, we can actually add back into their debt ratio and add back into their qualifying income. So making sure that that's calculated upfront for you. And same thing with the pay stubs. We want to make sure that we're calculating everything down to the penny for the buyer to make sure that they're going to be properly pre-approved.
I love that. Yeah, because the last thing you want to do is go all through the contract and have a little issue at the end.
Yep.
What are three things that buyers should not do while they are on their way to the closing table?
The first thing is not opening any new type of credit. And what I mean is new credit cards, new car loans. I understand life happens. There are unexpected instances and situations, but you want to do everything you can to avoid opening any new debt. And the reason is once the loan is closed, there are random audits that are actually done on mortgages by lenders and by Fannie Mae, Freddie Mac, the FHA, and the VA, the four major backers and entities of mortgages. And if they see that within 30 days of closing on that new home, you went and got a brand new car afterwards, or the process was started, they can actually call the loan due. And
Oh,
we want to make sure that we're setting the buyer up for as much success as possible and that they're not going to be in that position
I mean, what
to
happens? What happens if a lender calls the loan due?
the loan has to be repaid back in full, typically within 30 days.
I mean, how would they do that?
At that point, they would have to requalify for the mortgage.
Wow, that is
And
scary.
yep, and that's why it's one of the biggest things. You know, I like social media. I know you do. We were actually just talking about the meme the other day. As a realtor, watching your buyer pull up to closing a brand new car.
Mm-hmm.
We want to make sure that, as the buyer, you're limiting any kind of credit risk or exposure you're putting yourself to with any potential, new purchases. The other big thing is you don't want to quit your job and start a new one. If you have the opportunity, let your lender, let your loan officer, let Liberty know upfront because we can still work with it. Just because you're going to switch jobs a week into starting the process of buying a new home. Again, been doing it 15 years. I know exactly what we need to get. So we can still make sure that you don't have to bypass that dream job and we can still get you into the new home. You know, third thing I would say not to do is never go silent on on anybody. You
Oh,
know, myself, Liberty, we're both here to make sure we guide you through the process and make it as simple and easy as possible. And we want to make sure that you're communicated with, you're updated every step of the process because there are times I don't even have an explanation for it. Buyers will just stop responding. They still want to buy the home, they're still going through everything, but they'll just kind of stop responding intermediately.
I've only had that happen once out of the home purchases that I've worked on with buyers, and he was on a cruise and he just forgot to tell us that he was gonna go. And I was about to call for a wellness check. Yes, you call us before you leave town so that
Yep,
we don't have a heart attack and our hair doesn't start going gray.
exactly.
Because we will show up on your doorstep.
We got to make sure they're still there.
I know. Well, this has been so fun. I know that anybody who sees this is going to be able to take a ton of value away from this class. I'm, of course, going to send this out to anyone who's requested it. So if you guys watch this and have questions for us, we're here to be a resource for you. Please feel free to reach out. There are no stupid questions.
Yeah.
Believe me. I mean, we work in this every single day and things change with the zoning, with the properties, with the market, with the loan products. So we're constantly having to learn, and we don't expect you guys to know.
No, we do this literally every day, 10 hours a day. And that's what we're here for. We're here for to deal with everything in the back end, the complicated stuff, all of the requirements. So that way the buyer can just kick back, relax, get us a little bit of stuff that we need during processing, and then just be ready to close on a new home and sign on the dotted line.
Perfect. And that's always the warm, fuzzy feeling that we love the most, being able to get you guys the keys to that house once the loan is funded.
Yep.
And on the last note, before we say goodbye, Matthew, what do you think this year is going to do for interest rates in 2024?
So interest rates, I do believe they're gonna go down. Every year we have what are called peaks and troughs. I say ups and downs in the interest rate in the market. It's just a historical thing. The good thing with rates for this year is we know the Feds are going to be cutting interest rates, which is going to help mortgage rates decrease over the second half of the year. The other really nice thing, going to get just a little bit more technical here. So typically, historically, the spread. Interest rates are based off of the 10-year treasury. Historically, there's about a 1.7 to 2.1% spread between the 10-year treasury and where interest rates actually are. So right now, at the highest point of the historic spread of 2.1%, interest rates right now should be sitting at about a 6.3%. We're a little bit back over 7% because of the jobs report, the inflation report. So we know just the natural correction of interest rates. We have about, anywhere from 3/4 of a point of correction coming over the next 6 to 18 months, depending on how quickly the Feds actually start cutting their lending rates. Once they start doing that, we see rates dropping at a much, much faster pace. I would say as long as everything stays on pace for the year, we should be back to the low sixes by the end of the year. So a good 1% drop, which could equal, anywhere from $300 to $500 a month lower payment for a buyer, and back into the mid fives by summer of next year.
Well, that sounds optimistic to me, and I like it.
Yep, but we have to remember lower rates brings increased competition, brings more buyers out of what I call the sidelines.
That is exactly right. And I'm going to share my screen one more time. Can you see this chart here,
Yep,
Matthew? Now, this considers January 2021. This is 20 all of 2020, 2021, 2022, 23, 24. And look at this. Even with the rate increases and all of the market craziness, you can see here that there is a very clear seasonality to our market. in the beginning of the year, we'll slowly get more homes on the market, more homes will sell. So it's increased inventory, but also increased activity. And then as the year goes on into the fall, we'll see less homes entering to the market, less inventory to choose from, but there might be some more negotiation power there. So
Correct. I mean, we're
that's
quickly entering into that spring,
Mhm.
summer, buyer season.
That is exactly right. Well, thank you, Matthew, for this class. This has been wonderful. We're going to make this a regular thing. We have our schedule to build out. So once we have that together, we will let everybody know. Also, please shoot us a message, DM us, tag us. We want to answer your questions. So just throw them out there for us. Isn't that right?
Yes, man. We are here, like I said, myself, 7 days a week. Once Liberty sends out the information to everybody, don't hesitate. Don't feel bad. Email, text, call. We are both truly here to help out.
That's exactly right. Well, thanks everybody. Thank you, Matthew. Have a
Thanks, Liberty.
wonderful rest of your day. And did you have a good Valentine's Day yesterday?
I did. It was nice and relaxing. Made the wife filet mignon, spinach risotto, and grilled asparagus.
Oh my gosh, you sound spoiled.
A
That
little
sounds
bit.
off. That sounds awesome. All right. Well, I will talk to you soon.
Thanks. Have a good one.
You too. Bye bye.